As we say goodbye to a turbulent 2022, all eyes are on the opportunities and challenges that await us as we start 2023. With one of the most volatile and difficult investing conditions in recent memory, including spiking inflation, increasing interest rates, and the possibility of recession, it can be difficult to know where to turn for advice. But fear not, savvy investor. In this unique video, we'll delve into the techniques of none other than the world's most successful investor, Warren Buffett, and find his secrets for successfully navigating the turbulent waters of 2023. Don't miss this opportunity to gain valuable insights and potentially transform your portfolio. Make sure you watch till the end to get a comprehensive report on how and where Buffett thinks you should put your money in 2023. Warren Buffett is not only one of the world's most successful investors, but also the master of stock market prediction. He made money by spotting undervalued firms and making strategic purchases at discounted prices. What is the secret of his success? Patience. He waits for the right chance to strike, then capitalizes on it by purchasing in bulk and holding on to those stocks for years. Because of this technique, he owns holdings in some of the most renowned and profitable firms, including Coca-Cola, Apple, and American Express. But it's not his strategic investment plan alone that sets him apart. It's also his temperament to invest. It's very interesting when you realize from the video that if you don't have the right temperament, there's simply no point in trying to become a successful stock picker like Warren Buffett. His number one rule is to never get emotional about the stock market, no matter how good or bad the company is. If you can't control your emotions, you'll only end up making mistakes. Warren Buffett is one of the world's best stock pickers, and he has a rule that everyone should follow if they want to be successful like him. He says that if you can't control your emotions, you'll never be able to make sound investment decisions. If you're too emotional about the stock market, you'll buy and sell stocks at the wrong time, ultimately leading to losses. If you're looking to invest but can't keep your emotions in check, passive investing through ETFs and index funds may be a good option. Essentially, this type of investing entails purchasing a stock that represents a diversification of investments, as well as market-wide diversification. This can help protect you from a stock's fall in price, as well as give you a better understanding of the overall market and its movements. The concept is to consistently invest in the market regardless of the current conditions. Doing this year after year for an extended period eliminates the emotional aspect of investing. Instead of trying to time when to buy or sell or choosing specific companies, this strategy is about consistently supporting the market as a whole. Over time, this leads to earning the average market return. Additionally, it's worth noting that this approach is recommended by Warren Buffett, widely considered the top active investor in the world for the majority of investors. Suppose you're tired of the psychological stress and uncertainty that comes with trying to pick the perfect stocks or timing the market. Look no further than dollar-cost averaging, a tried and true strategy recommended by none other than Warren Buffett himself. Not only does it protect you from your own emotions and market fluctuations, but it also allows for the magic of long-term investing to unfold. If you don't believe, just look at the numbers. Sure, there may be periods of market stagnation, but holding on for the long term can lead to staggering returns. Imagine going from a zero return over 12 years to a 187% total return in just 10 more years. With dollar-cost averaging, the consistency and reliability of your investments will leave you feeling confident and at ease. Nevertheless, the actual cost of dollar averaging is the best option since it shields you from two risks. It shields you from your own emotions, and it also protects you from what may be large market movements. Because if you stick with it for a long time and continue to show up year after year, you'll eventually average out to the average market return. So make a plan, stick to it year after year, decade after decade. And that is why Warren Buffett likes this method so much and is eager to promote it, even before he recommends his investment technique. And he's had this viewpoint for a long time. Warren Buffett has long advocated for the use of passive investing strategies, specifically the use of index funds for most individuals. He believes this approach is the most effective way for the average investor to achieve their financial goals. In his annual letter to shareholders, Buffett stated that the most institutional and individual investors would find that the best way to own common stocks is through an index fund that charges minimal fees. He argues that those who follow this path are sure to beat the net results after fees and expenses are delivered by the great majority of investment professionals. The reason for this is that index funds, by their nature, provide a low-cost and diversified way to invest in the stock market. They're designed to track a specific market index, such as the S&P 500, and provide exposure to a broad range of stocks. This allows investors to reap the benefits of stock market returns without needing active management or stock picking. Buffett's assertion is supported by data and statistics. For example, according to SPIVA statistics and reports in the U.S., 78% of active funds haven't beaten the S&P 500 over the past 5 years. This means that 78% of actively managed funds have failed to outperform the broader market. Similarly, 80% of active funds in Australia haven't beaten the S&P ASX 200 over the past 5 years. In fact, Warren Buffett was so sure that active funds would underperform index funds that he made a $1 million bet with Protégé Partners, LLC that over 10 years, a hand-picked selection of hedge funds would underperform the S&P 500. And sure enough, Warren Buffett won the bet easily. This further underscores his belief that passive investing strategies, such as index funds, are the best way to achieve long-term financial success for most individuals. Buffett's recommendation of index funds is not limited to the general public. He has also recommended them to many high-profile individuals, including celebrities, demonstrating that he truly believes in the effectiveness of this approach for all types of investors. Also, Buffett's value investing approach has proven to be highly effective, and adopting it can potentially achieve great returns on your investments. Value investing is all about finding undervalued companies with strong fundamentals that have a clear growth path. This allows you to make informed investment decisions and avoid the risks associated with most speculative investments. And by focusing on the long-term potential of a company, you can potentially reap significant rewards. In 2023, the stock market may present opportunities due to a potential recession, but it's important to remember that this also brings increased uncertainty and risk. However, by staying patient, disciplined, and focused on your investment strategy, you can potentially capitalize on these opportunities and come out on top. As an investor, the last 12 months have probably been a difficult time for you. With interest rates on the rise, you've likely seen a decline in the value of your stock portfolio. Stocks in lesser-known companies that gained popularity while rates were low have been hit particularly hard. One example is Arcimoto, a company that manufactures and leases three-wheeled electric vehicles. Since the start of 2022, the company's shares have fallen by a staggering 97%. After reaching a peak price of $637, the stock is now back to $3.91. This type of stock is one that Warren Buffett tends to avoid. It's a new enterprise with uncertain prospects and a high price tag relative to the cash it generates. In general, Buffett's strategy of avoiding speculative stocks like this has proven to be wise as the tide turned in 2022. That's why the shares of Berkshire Hathaway, the company he leads, have held up well compared to the broader stock market. Instead of looking for undiscovered future winners, Buffett prefers to buy shares in established companies when they're unusually cheap. A good example of this is American Express, which he bought shares in after the company had been embroiled in a scandal in 1963. As a result, he was able to buy the stock at a price equivalent to 94 cents today. Right now, a stock that you might find interesting is Meta Platforms, a company that's facing antitrust charges from the EU. This has been weighing on the company's share price, but some believe the fear is overblown. This may be an opportunity for you to buy the stock at a discounted price. Beyond Meta Platforms, you may anticipate more investment opportunities in 2023 as an imminent recession is expected. However, it's important to note that a downturn is transitory, so it's not a permanent slowdown in corporate profitability. Earnings may return to growth mode by the end of 2023. Therefore, it might be a good idea to exploit the pessimism in the stock market earlier in the year. That's why your plan for 2023 might be to stick to the basics. Buying shares in strong businesses at bargain prices may be easier for you next year than it has been recently. Companies like Intercontinental Hotels Group, Halma, and Diploma, which are likely to be affected by a recession, may be on your radar for potential investment. The bottom line, Warren Buffett, often considered a top stock market expert, suggests that passive investing and value investing strategies are the most suitable option for most individuals. While these may not be his preferred method for making money, he believes they're the most appropriate for most people. The primary reason for this is that passive investing eliminates the primary challenge faced by active investors, which is their emotional state. As a passive investor, it's not necessary to have the ideal mindset. It's simply important to invest consistently and stay committed to a dollar-cost averaging strategy. Moreover, by following Warren Buffett's value investing strategies, you can potentially achieve great returns on your investments. It's a smart and tested approach that can give you the edge you need to succeed in the stock market. Let me take this chance to thank you for watching this video, and as usual, if you found it helpful, drop a like. Also, subscribing to the channel will encourage me to make more videos just like this one.